When CPI comes out, there are two things that come with it: big moves in the markets and big uncertainty in the market's direction. But what if you could reduce the uncertainty and instead just focus on catching the big move? I've been trading CPI as part of my strategy for over 6 years now. And I've learned that there are three things you can do if you want to reduce your risk while trading CPI. And before we get started, I just want you to know that CPI is inflation. So you're going to hear me use these two words interchangeably throughout the rest of this video. So before we can answer the question, is trading CPI worth the risk? I first want to define what the word risk actually means. And the word risk comes from the Italian word riscio, and it just literally translates to exposure to danger or loss. This is a term that was used by sailors, and they were referring to the dangers at sea, things like rocks, storms, and enemy attacks. So instead of saying, is CPI worth the risk, we would say, is CPI worth the exposure to loss? Every trade that we take has some exposure to loss. So the question you're asking is CPI worth doing that for? Maybe, but this is a perfect segue to go into number one. So the first way to reduce your risk when trading CPI is just to avoid doing it altogether. If you never trade CPI day, then you have a 100% chance of never taking any losses that day. But doing this actually introduces a new form of risk. This is called the risk of missed opportunity. When I first started trading, everybody was saying the same thing. Stay away from red folder days, don't trade the news, it's manipulation, whatever. But when I was looking at the markets, I noticed a couple different things. On a regular day, let's say this is your regular volume, right? If you were to look at the volume, that's a really bad drawing of the markets. Consider it a trend. But when you look at CPI day, it was like the moves were 100 times what we were getting on a normal day. So I'm sitting back and I'm like, how come everybody is saying, don't trade this? It doesn't make any sense to me. And if you're one of the traders that are like, number one, avoidance, that's totally me. I'm gonna give you a question that I asked myself, which should hopefully give you like a reframe on how to look at this. Instead of asking yourself, is CPI worth the risk? I would look at moves like this in the markets, like how massive they were. And the question to me instead was, is trading CPI worth the reward? Because if I see some big move on CPI day, I can't be upset that I didn't take the trade because I wasn't willing to take the risk. So if we have 100% avoidance of a loss, we're also going to have 100% avoidance of a win. So the first way that we just covered that you can reduce your risk while trading CPI is avoid. If you don't want any risk, just don't do it altogether. Now the second way that you can reduce your risk while trading CPI is learn. You can reduce your risk in just about anything that you do by knowing more about it. I'm going to use two traders as an example to drive this home. Now let's start with trader A. This trader has no idea that CPI is coming out, but he's still trading, and he's watching the markets. We get some volume, and then out of nowhere, we get this massive spike. What do you think this trader does when they randomly see volume coming in and they're trading? Most likely get in the trade. They'll enter at the first piece of volume that they get. This type of trading is extremely 50-50. Take a look over at trader B. Trader B understands that CPI is coming out. So number one, we're prepared for it. Number two, trader B also knows if CPI comes out higher, that means that the Federal Reserve is going to raise interest rates. Interest rates are bad for NASDAQ. So if I see higher CPI, I'm going to take NAS sells when inflation data comes out. Based on the preparation and analysis between these two traders, which one do you think is actually going to survive in the markets long term? So how can we get to be more like trader B? In order to analyze CPI like this, I want you to be able to answer three questions. The first question that you have to answer when analyzing CPI is, what do you trade? Because without knowing the thing that you're going to trade, it's going to be very difficult to analyze how the markets are going to impact it. And the second thing that you want to be able to answer is, how does inflation actually impact it? So if we'll talk about NAS, gold, NASDAQ, inflation typically is actually good for NASDAQ because it creates more liquidity in the markets. Gold, same thing, but for different reasons. Inflation is actually good for gold too, but because gold is a safe haven, because gold is a hedge against inflation. And if you think of things like the US dollar or the currencies, it's actually bad for the US dollar because inflating a currency makes it less valuable. And the third question that you want to answer when you're trying to analyze CPI is, how do interest rates impact it? This one's a little different because interest rates are used to control CPI. Higher interest rates are bad for NASDAQ. Higher interest rates are also bad for gold. But for the US dollar, I'm losing space here, but for the US dollar, higher interest rates are actually good for it. So the first way we covered that you can reduce your risk while trading CPI is that you can just avoid trading it altogether. If you're not trading it, you're not gonna have any risk. The second way is that you can learn more about it. If you understand how the market's going to react to CPI, this will naturally lower your risk when you're taking trades. And the third way that you can lower your risk while trading CPI is that you can optimize, which is just another way of me saying journaling your trades. Now, when I'm journaling, I want to journal two specific things. Number one, how do the markets move? And number two, how did I perform in those markets, right? So basically the trades that I took. Journaling religiously is probably the number one reason why I'm a successful trader. And I'm going to share with you my 3-step framework on how I journal my trades. We're going to start with record. And all I'm doing here is I'm going to document. I want to document any trades that I took. I want to document if any news came out. I want to document my emotions. I want to document how I felt if I took any losses. Everything that happened in the day of trading that I was trading, I'm going to document all of it as thoroughly as I can. And this is going to move me to phase 2. This is the review phase. What I'm going to do here is I pick a day. For me, I normally pick Sundays because it's the first day before the trading week starts. So it's a really nice refresher for me. And in the review phase, what I'm doing is I'm just looking back at all of the journaling that I did in the prior week, but I'm looking for something specifically. I'm gonna be taking notes, and in these notes, I'm gonna be looking for things that I'm doing that I don't wanna be doing anymore. And I'm just gonna write it down. No emotions, no judgment, no nothing. And what we're gonna do with this nice list of notes is we're gonna come over to the refine stage. This is where you apply it to your trading plan and you're gonna change things. So this is how you come up with rules, or at least for me, this is how I come up with rules for my trading plan. I create the rules based off of myself, how I trade, and how the markets react, or how I react to the markets. So reducing your risk while trading CPI comes with these 3 simple things. You're avoiding, you're learning, or you're optimizing. And I hope after watching this video, you're no longer gonna be avoiding, and instead, you're gonna learn and optimize. I'll see you guys in the next video.